Hello and welcome to Investors Hangout, your weekly guide to making smarter financial decisions. This series is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Today we are discussing a very common dilemma. For long-term wealth creation, should you chase the high growth potential of equity funds or play it safe with hybrid funds? To discuss this and more, we have with us our in-house expert, Dhirendra Kumar. Welcome, Dhirendra.
Thank you.
First up, for beginners and long-term investors alike, how should one choose between equity and hybrid funds?
One has to look at hybrid fund differently. There are multiple kind of hybrid fund. For long-term wealth creation, when we are talking of hybrid fund, we are talking about aggressive hybrid fund. Why aggressive hybrid fund? Because they are almost equity fund. They are 75% equity, 25% fixed income. For any new investor, I think it is mandatory. In fact, if we are able to, somehow encode something in the law that if you have never invested in mutual fund, if you are investing for 5 years and more, and if you are starting with SIP, you must start only with aggressive hybrid fund, nothing else. That will actually do a lot of good, because what happens is it turns out to be a great, or I would say an excellent gateway investment. Most people start investing when the going is very good, when you are excited, when your friends say that, why are you not investing? When you see that, okay, your friend has made money, your neighbor has made money. And then you start investing, and then you start investing in a fund which might turn out to be the most riskiest one. Because the one which is the riskiest delivers the most return in the short term. And the one which is delivering the most return looks the most attractive. And that is where you start. And the moment you start investing in a matter of some time, whether it could be weeks, it could be months, or it could be few months, it crashes. And when it crashes, the first time experience of any equity investor starts with a fund which is devastating. Sometimes it can derail your long-term plan. That is why aggressive hybrid. Here is a fund which is diversified, which has proven, which has 75% into equity. When the market crumbles, it does not collapse. If you look at anybody who is learning new things, you start with a cautious thing. You don't start, with the most speedy car. You start with something where you have greater control, where you get used to it, and you in a calibrated way. And that is what aggressive hybrid fund is. This is the reason why you should start with that. Then comes after you have done it. You have done it for 10, 15 years, 20 years, you have accumulation. Then also their role actually grows substantially, because you have the fear of losing money once you have accumulated something meaningful. That is the time, also the time in your retirement, if you have to, assuming that you're 65-year-old and you don't need the money, you don't need the income, and you have invested for long term. Still, you should consider this aggressive hybrid fund for two reasons. One is that you have meaningful money. When the market goes down, you have regret. Second is that, you need to rebalance periodically to profit from these kind of intermittent decline and surge. These funds are able to do it without any tax incidence on you. No tax implication whatsoever. These funds remain 65-35. So if this 65 becomes 75, or if this 75 becomes 80, the fund will realign, rebalance, sell equity, buy debt, or buy debt, sell equity, and it will have no tax implication for you. So it is a very tax efficient vehicle for people who have substantial accumulation. It is a risk moderation tool, and for any first time investor, it is a greatly confidence inspiring experience to begin with for you to get used to. So in all your life, if you are starting to invest at 25, till the age 30 start with hybrids, and 30 to 60 do it with all equity fund. And after that, get on to hybrids, because then you would like to have a passive, low maintenance, taken care of, and not scary experience.
Okay. So, but once that is done, how should we think about risk and recovery in equity versus hybrid funds during market crash?
In a market crash, all crashes are not equal. Sometimes exotic things fall so much more. Some sectors don't fall at all. So and every crash is a different one. I remember, the most devastating one was post 2008, when we saw the surge in infrastructure fund and infrastructure companies, and many of those funds actually went down by 65-70% in a matter of 5-7 months. Likewise, in technology boom, year 2001, the dot-com collapse happened. It happened elsewhere. But the technology companies in India, they fell so much. So technology stocks fell so much more, but not all other stocks. But the overall market did not recover for a long time. Equity versus hybrid, no, the real thing to compare is that how bad it can get. And it's not about equity versus hybrid. I'm talking of the hottest equity compared to the hybrid, because we are not comparing hybrid as compared to a generic. In 2008 crash, which was the most recent big crash or big decline, the average equity fund fell by 60%. The aggressive hybrid funds were down 50%. And the balanced hybrid fund, which is nearly 50-50 into equity and debt, they were down only 40%. But that is not the right comparison. The real comparison is where were people investing before the crash? And people were investing in infrastructure fund. They fell by about 65%. So one should actually be looking at the hottest part of the market, the way it declines, and how hybrid is able to withstand that. Losing a third of your capital is not all that bad, as compared to 70%, 80%. But it is not a consolation. It is not a guarantee that you invest in hybrid. But for somebody who is gradually investing, of course, if you are able to combine these two things, start with aggressive hybrid and start doing your SIP, never invest lump sum, then you will be sorted. Because those 8 months, 9 months of big decline or secular decline or steady decline, you'll be buying cheaper.
So that was about market crashes. Now, when it comes to long-term investing, say 10, 15 years, what difference does the choice make for SIP investors?
Over a period of time, if you are able to choose a decent fund, if you are able to choose an above average fund, or if you compare it with this, when you look at 10,000 rupee SIP in a hybrid fund, and through a phase of 10, 15 years or 10 years in which there was a falling phase, there was a rising phase. And when I look at last 10 years Nifty 500 index fund, that would have yielded an unmanaged index fund, top 500 stocks. That would have, there the money would have accumulated to about 26 lakh. As compared to that, in an aggressive hybrid fund, it will be about 21 lakh. So it's nearly 25% less or 20% less. So 20% less is quite meaningful. So I would say that this is a great vehicle for somebody to acclimatize. This is a great vehicle for somebody to make sure that you don't become your own enemy in case of market fall. Because most people run out of the market and they're deprived of the market in those times. So once you have something meaningful and once you are getting used to, it is very important. But to grow your money well, and you should switch track to equity, an all equity fund. And for that, those, as I was saying, that from 30 years to 60 years, you should be in 100% into equity. But getting used to, and once you have something sizable, then move to hybrids. That will help you, that will also help you, keep away from anxiety in old age.
Right. So you're saying that hybrids provide the cushion, but what really is the price of buying this piece?
Everything comes with a cost, and it reduces your cost by 1-2%. If you look at the 20-year return from hybrids, aggressive hybrid that we, and last 20-year returns of hybrid is not necessarily a reflection. It is little less. Reason is that, till about 10 years ago, these hybrids were 51% into equity. For about 6-7 years, till about 6-7 years ago, they were 65% into equity, because then their allocation is changing with the tax laws. Initially, they were called balanced fund. Now they are called aggressive hybrid fund. Now they can invest up to 75%. But despite this, despite that 51% or 65% and now 75%, their average return is about 2% less than the long-term return from actively managed equity fund. When I look at 20-year return, it is 14% from equity funds. It is 12% from these funds. But these funds were not as much equity till about 10 years back. Nevertheless, I think that is you will have to compromise a little bit on return, and you will get the comfort of far greater stability because of the 25% cushion. So that is the deal.
All right. So the message is clear. While equity funds can provide you better returns in the long run, hybrid funds are necessary to provide you the stability and behavior management. Now, moving on to the viewer's question. After watching our Investors Hangout episode on investing 1 crore rupees retirement corpus, Sunita has written to us saying that very good questions and excellent replies by Dhirendra sir, but please advise if it's okay to park in fixed deposits to some extent for guaranteed monthly income in addition to post office MIS, as I have exemption up to 12 lakh rupees.
One should necessarily invest in fixed income to the extent that the fixed income that you will derive from there is necessary. If you have already invested in post office MIP, you have exhausted your senior citizen savings scheme entitlement, and after that you still need some income, and that needs to come in a predictable manner. That should be fixed deposit. But I would say that consider, because fixed deposit returns are very low, and many a time they are unable to beat the inflation. So I would say that take little bit of risk. First, exhaust the guaranteed return avenues like post office and senior citizen, and they're also the highest yielding. After that, consider something called conservative hybrids. These funds invest about 9 to 11% into, or 10 to 15% into equity, remaining into different kind of fixed income which might yield little higher return. And you are not liable for taxes on these investments till you realize any of it. And even when you realize, the gains will, this will be about 10-11% is my expectation from these funds, based on the quality of their fixed income return investments and the equity component. And if you are able to derive even 10% return from such an allocation, this is almost like 20% more than, or 25% more than what you will earn from a fixed deposit. So consider that. But I agree that one should have as much of fixed deposit to the extent that you need reliable, predictable income you want to be very sure of.
All right, well, that's all we have for you in today's episode. Keep watching the space for more information. Keep sending in your questions. We'll be back with another episode next week. Thanks for watching. Bye for now.